issue, Lakshman, you say they should have already been cutting?
Yeah, we're way past the due date.
I thought we're in a good economy.
Well, the headlines might suggest that. You got unemployment low, you have GDP high. But I think a lot of people forget that the last GDP print before the last recession, real time, guess what it was?
Strong.
4.9%. So that doesn't tell you.
Which quarter was 4.9?
This was third quarter. You had in the fourth quarter before end of 07. So that's the way coincident lagging data works. It doesn't tell you about the future. You have to look at leading indicators.
Like what?
Like leading indicators of the economy, like the weekly leading index we put out there. It showed the slowdown, and we are decelerating in growth for the economy. But more importantly, what's been going on with the markets, all the drama, is in the bonds. And what's going on there, when you deconstruct what's moving it, it's really inflation expectations, which stayed elevated through last fall and then started to move down. And in very recent weeks, last 6-7 weeks, they've really made a move down. And that is underscoring, from a cyclical vantage point, the inflation cycle downturn that began last July, which you could see by the fall. And so if you're going to be preemptive with monetary policy and smooth things out and try to forestall bad things from happening, you can't do more later. That's not how it works. It's all about timing, being preemptive. And so they are late.
Anthony, on the other hand, you don't think there's any immediate urgency to cut?
No, I really don't see it, because I agree with Lakshman that you have to look forward. But when I look at the second quarter, the numbers look very strong. The Atlanta Fed just revised upward their expectations for the second quarter to 2.1%. Remember that in early May, that number was 0.9%. Now it's stronger. Now let's look at inflation. We know the core inflation number came in at 2%. But Lakshman says we should look at the future, and I agree. But guess what? The University of Michigan, looking at inflation expectations 1 year into the future, is 2.6%. If the target is 2%, 2.6% seems good. Now, people say, well, that's just 1 year. I don't trust it. Well, look at the 5-year median inflation expectation, 2.2%, still above the target. I am not saying that at some point the Fed doesn't have to lower interest rates, but right now, there's no immediate need. Last thing, University of Michigan, how home buying expectations, over 140, jumped more than 10 points. People are not going to think and be excited about buying houses if they think inflation is going down. They'll wait. And right now, this month, the University of Michigan is telling us people are excited about buying houses. It's not because prices of housing are going to go lower. It's because they think they could go higher. That doesn't sound like deflation to me.
So I hear you. We're looking at the rate of change, like what's going on with the direction of inflation, and things like the PCE core, which is really central to the Fed's thinking, hit a peak of about 2% in July of last year and has been decelerating. It's about 1.5%. But more importantly, what's up with the bond market? I mean, it is emphatic.
But it's QEing overseas, so money is sloshing around somewhere.
Well, it's inflation expectations everywhere. There's inflation cycle downturns here, and there's inflation cycle downturns there, in Europe, in Japan. It's cyclical. And, those are market-oriented economies, too. And we had a reflation in 16 into 17, maybe into a little bit of 18, and then now we've cycled down. It's not more complicated than that. It's a cyclical downturn.